Welcome to the May edition of AML Conversations with Sarah Beth Felix. Sarah Beth is the head of Palmero Consulting. She's also working with a bank. Well, Sarah, how's the bank situation going? I don't think everybody that's in our space knows what you're doing in that. I thought maybe talk a little bit about how that's going.
Yeah, so it's actually going really well. We have our charter from the state of Vermont. We have an uninsured non-depository charter. We are disrupting, we like to say we are disrupting wire payments, which I firmly believe will never go away. I know everyone's really hot on digital assets, but with all of the fraud that happens, I think people like the delay. They like the friction that happens in wires, and there's lots of areas to fix, and that's what we're doing with our a de novo bank, and we're pretty close. I'm hoping to getting our master account. We've applied for it. We applied for it several years ago, and we're in the process of going through that. So
Right.
we're hoping to open the doors here before the third quarter this year. So stay
Great.
tuned. Yeah.
Yeah, keep us posted on that. So, as we've been doing since we started these conversations are a look back at the month we've just ended. And obviously, we're um, looking at the month of May. And the month of May had a bunch of things going on in our space, internationally and domestically. But we want to focus on a couple things that you've written about. Remember, Sarah writes Dirty Money Weekly, which is a free you can subscribe newsletter, which has excellent practical and advice and sort of, I don't say in the weeds, because I don't think you're doing in the weeds. Your in the weeds stuff is in your LinkedIn post, which is a good thing, by the way. And they should be following you. But Dirty Money Weekly will give you a snapshot of some things that you think are important for AML professionals. And so you've done obviously several of those in the month of May. So what I'd like you to do, there's two consent orders. There's an OCC consent order and an FDIC consent order. Tell us a bit about those. We've also had a couple of executive orders that obviously impact or potentially impact the AML community. And then we'll cover some other items. But to talk about some of the consent orders, and I would just say as a preface, I've always believed in all the years I've been doing this that regardless of the size of your institution, a consent or enforcement order of any kind is a valuable training tool for AML professionals in any space. So basically, you should take these orders, see what it was where the gaps were, and sort of map your institution or your client's institution to those issues. So having said that, Sarah, let's talk about those two orders.
Yeah, so I will say that I kind of became known as like the consent order breakdown lady for several years there, and then things have been kind of quiet over the last 18 months or so. Not that we haven't had any, but we went from a cadence of about 4 to 5 a month for several years to one every 4 to 6 months, which is I think kind of generally speaks to some of the things that are going on. And I think it has in turn provided boards of banks and credit unions and executive management teams. I think that they now see that as, oh, we can take the foot off the gas pedal, right? We can just kind of be okay. We don't have to keep refining and testing and, doing all these things. And I think these two consent orders actually, to me, they actually should signal to board and management, you have to put your foot on the gas pedal. Like, you cannot just stay in neutral and just coast until, whenever you think that the change in administration is going to bring a change in our rules.
Right.
So with that, this consent order, I will say I was not surprised. And that's only because I work with both fintechs and banks, and this bank comes up a lot in the work that I do. And the thing that I want people to remember.
What was the bank? Tell folks what it is. Yeah.
CFSB out of New York. They are known in the fintech and digital asset bank. Jason McCullough, like we were talking about earlier, he writes a great kind of, he puts out a good landscape about, who banks with them. I won't go down that path, but I do want to say that, like, even if your bank is not a fintech bank or digital asset banking bank, you still have things to learn from this. And I think one of the things that keeps coming up over and over and over again is a clean audit is not a good audit. Like, and I've said it for many years. In fact, I am going to make swag with it. That's just a nice Stark coffee mug that says a clean audit is not a good audit, because that is the thing that keeps coming up, regardless of whether or not you're a $108 million bank like the one from the FDIC that came out a few weeks ago, or this one against CFSB. There are specific words used in the consent order that should signal to every single traditional financial institution, if you are getting an audit and your audit is clean, that is not something to hang your hat on. And so to me, that was kind of like the main thing, that regardless of administration, that to me is never going to change. A clean audit is not a good audit.
What does that actually mean for people that don't know the audit function? Because it would sound like those that aren't engaged, clean audit, that sounds like we passed everything. What do you mean by that?
Well, your audit is supposed to be your partner. As somebody who's a recovering auditor, that's what I tell people. I still dabble in audits, but for the most part, I've stopped doing them because examiners I found over the years would take the hard work of an auditor and the partnership that the audit is supposed to be, also very independent, but a partnership.
Right.
And an examiner would come in and take all of that work and say, oh, well, here, now you're in trouble because look at all of these gaps. And that's not the way it's supposed to go. So I stopped doing a lot of audits. Now I do gap reviews and do other things, right, that aren't the official audit. But the thing that people have to remember is that you want your auditor to be in the weeds. Like, you want your auditor in your data, going through the threats and going through the typologies and going through the alerts from FinCEN and comparing it to your data, comparing it to your customer base, comparing it to your member base, and finding gaps and holes. That's what you want. Now, is it fun? No, it's never fun to get, an audit report that says, hey, you're missing the mark in these areas. But that is way more fun than having an examiner tell you you're missing these things. So you need your audit function, and your ego cannot be tied to the output of that audit. And that's a tough thing for humans, right? That's just a human nature thing. No one wants to be told, as Lauren Core always says, that your baby is ugly, right? Which is what most of us feel when you've poured your life into that product, right? To that program. You don't want an auditor to be like, sorry, this is not great. But you want that over an examiner telling you that. And so I think what we're finding, and this again goes back to the last administration, to this current one, a clean audit is not a sign of a strong partner. And I think that for me is the biggest signal out of this one.
So is the criticism then more on the audit function for not doing their job to go, using your phrase, in the weeds? So that's the problem. It sounds like a clean audit seems like a cursory review, almost a check the box sort of situation. Exactly. Whereas what you're advocating, and obviously what the regulators are finding fault with, is you need like you say, a partner, an in-depth analysis. And even if the AML office isn't happy with that, they'd much rather improve their situation with internal audit than, of course, with an examiner.
Yes, that is right on the money. I think my caveat to that is, for all the auditors, this does not mean that you go check the box issues. And that's what I find out of this. It's like, oh, you transposed a date of birth on a CTR. That is not an effectiveness issue, right? So that's where getting into the material risks, and that's where this order was very clear that their audit over time missed the unregulated payment processors that are at the heart of their failures. And I think that's because most auditors are not used to thinking like a criminal, right? To going into the data and going, okay, I am going to use this bank, use this credit union to receive dirty funds, or I'm a, an illicit actor and I'm going to use their product and services. And they aren't starting there at the audit. They're starting with the checkbox, like you said. So I think that probably was my biggest thing that I saw out of the
Biggest takeaway.
order.
Yeah. Mm-hmm.
The second one would be for the fintech and digital asset banks and credit unions, master services agreement. And I say this a lot, MSAs, master services agreement, they are not creative. Other than one lawyer that I have met over the years, I have not seen an MSA that was actually custom, like tailored to the threats of that fintech and the bank and the regulatory environment, some unregulated, some partially regulated of that fintech. They're all just kind of broad brushed. And that's where I think this bank got in trouble, because the MSA didn't clearly say, hey, these companies that you're going to be banking, they are not regulated. So when the master services agreement says that this fintech will comply with all applicable laws and regulations, there are no applicable laws and regulations to these particular types of companies. Therefore, the bank, I think, was unaware of that. So
the other consent order on Covington, was it Covington Savings Bank? Talk about, that's a small bank, I think, in Mississippi, right?
Yep. Yeah, very, very small bank, 108 million, 110 million, something like that. There wasn't much that they got right. Like every single pillar and then some of the sub pillars, they had some criticism in. I think, again, the audit function came up. So I will say again, a clean audit is not a good audit, regardless of size, regardless of complexity. The other thing with this bank is that they were a commercial bank. And I find this a lot when I'm working and talking to CEOs of commercial banks. They have, I believe, an unsupported view that a commercial bank is lower risk, therefore lower AML resources, people and tech. And I think that's an incorrect way to look at it. I think the correct way to look at it is, if you are a commercial bank or commercially focused, commercially heavy bank or credit union, you actually need more technology, better technology, and more people, because the investigatory processes to determine whether or not you're dealing with a shell company or a front company, and then all of the unregulated and partially regulated fintechs and lendtechs that actually are used by your businesses, by your commercial clients, are very complex, and that adds minutes and hours to a standard, alert. And that's where I think this bank got into trouble. They just thought, oh, we're a commercial bank that's lower risk, lower people, a lower number of people, it didn't seem like they had any type of sophisticated technology solution. And they got into trouble. They have a lot of issues. And what really breaks my heart, I mean, not to be super dramatic, but I want banks to win. I don't want to look like certain countries in Europe where there's 4 banks. And we can't have shrinking community bank populations. And that's what we're having. And a bank this small that has this many issues, I don't see them surviving. And that is completely avoidable. There are hundreds and hundreds of other banks their sizes. We've had the manual to do this right for 21 years. And we have no more ways that we can say, you need to do something about it. And there's banks that aren't, and this is one of them. So.
Right. Again, people should read your description of that, both on your LinkedIn account and in the newsletter. Let's talk about these executive orders. There were a couple of executive orders. There have been so many in this administration. There's certainly a debate about the adequacy of these as legal documents, but obviously we have to react to them. There were 2 that are relevant to our world. Tell us about those.
Yeah, so I don't know the whole names. I like it better when
don't
they
worry about
do
the
the
names.
acronyms.
Yeah,
The
the
restoring
names are-
integrity is one, and then the
Yeah.
restoring integrity, and then what was it? The fintech one, integrating financial technology, something, I don't know. But the restoring integrity one, I think, I heard from a lot of people, different sides of the aisle on this one. And for me, and we talk about this a lot, I cannot be political, because I have to see How
Right.
does this work in everyday life?
Sure.
How is this going to work? And I found some things that made me go, well, I don't understand how that's going to happen when somebody is in a branch and they're, trying to open a checking account. Like I don't see how some of their steps that they went through in the um, restoring integrity one is
Right.
actually going to work. It seems to me to fly in the face of the CIP exemption that happened in July of last year. I'm like, wait, so you're saying that we can only collect the last four and we're trying to be up with technology, but then this one comes out and now we have to collect some signals of some kind that somebody may or may not be here legally.
Right.
That is unbelievably difficult. So we have to force them essentially to give us a work visa in order to, I mean, there's just so many things where I'm like, I don't even know what that looks like. I mean, even
Right.
as a consumer going into like, how is that bank or credit union going to know that, when I hand them an ITIN, that may not be a legitimate one, or I may not be here legitimately. I mean, there were a whole bunch of issues in in the one about collecting the tins and
So
figuring out what.
yeah, so we're going to have to wait and see what Treasury and others do. I was surprised to see a press statement from America's credit unions, whatever that trade
Yeah,
association is, thanking the administration for not requiring that they had to go back and revisit current account holders. But I think that's if that's what you're hanging your hat on, I think that's problematic. You think that's a big win, given what you've just said. I do think it's unclear how this is going to work, and the fact that that's not in there, I didn't think that deserved a commendation from a trade association. But that's just me. Having been at trade associations, I
yeah,
would never have done that. But the other one is they talk a lot. Everybody on all sides talk a lot about helping innovation. And I think everybody agrees with that statement, but what it means is obviously sort of depends on where you sit. What was the other executive order about? What's your take on that?
yeah. So the fintech one I thought was pretty interesting, especially when they came out on the same day and you read them back to back.
Right.
Um, I think the restoring integrity one should have been fully completed. And then the fintech one, based on the results of all the things that were in that restoring one,
Right.
then that should have had a bigger say in what came out in the fintech one, because the fintech one is encouraging innovation and then trying to build frameworks around this booming payment structure, and that's impossible. Then you add in the restoring one and it makes it 100% like never going to happen. None of this is ever going to actually make a difference in terms of regulatory framework, which is what the purpose was of the fintech. So I know I've been a long, I think well over a decade now, talking about the regulatory loopholes. So when they opened that EO statement with what I often say, and then they didn't put the last part of the sentence in when they're like,
Right.
"Oh, the U.S. is the number one in the world for fintech startups." I mean, it was something along those lines, which is what I say all the time. But the last part of the sentence is missing. We are number one in the world because we don't require anything. We have the least amount of friction. We have lower friction to start a fintech than China.
Right.
I
I
mean,
know.
that's not a good thing, right? So it is again, it made my head hurt. I know I said that before we started recording, but I'm finding a lot of noise and a lot of things that I can't process. I can't actually figure out how to do things and put it into the right bucket so I can move forward. And this fintech did not actually help with any of that. I think it glossed over the fact that we have outdated money service business regulations, that we have glaring loopholes allowed under CFR, where trillions of dollars flow through the U.S. without any money laundering, counterterrorism type of eyes looking at it at all. So I didn't see this fixing that. I saw it encouraging that with like a dash of regulatory, you know, maybe we should figure out some better regulations. And that's not, to me, how you do it. They didn't define fintechs, I think, in a correct way. And while definitions are boring and nobody wants to talk about it, definitions are vital to actually getting this right. And so when we lump all technology providers in under the fintech umbrella, we can't regulate them, right? Then we get a bottleneck, and then we got a ton of all these lobbying companies that come in and pick it apart. And, we have to have a concise definition. And that's where I posted what I believe is the right definition for a true fintech.
Yeah, right. And I appreciate that. And again, people should go back and look at that. We talked about this before we started to record. What I'd like to do when we have these conversations, and really appreciate, obviously, your extensive work on all these areas. I know in your weekly you provide some direct advice to AML professionals, so people should look at those. You had a really good list of 3, and the most recent one that I looked, I think you called it bucketizing, is what you called it? Yes. So people should take a look at that. But what we'd like you to do for these conversations is, as we put the finishing touches on the month that we've talked about, what's your one either takeaway or piece of advice to AML professionals based on what occurred this month? Now, again, obviously you have more than one, but just give us one. Doesn't have to be broad, can be very specific. What's one thing you want? People have listened to our conversation and say, in addition to what Sarah talked about in her weekly, she also said X.
Well, I will probably have to go with, it's kind of similar to the one of the 3 that I gave, but that's right. Because that's what I have to do. And I just said a few minutes ago, I'm getting to the point where it's all these things and I can't actually put them, in a neat place and resolve them in my head. So where do I go? And I feel like a lot of people are in that space. It's so many things that are coming at you. And I think the thing that we have to remember is that at the end of the day, regardless of EO, regardless of alerts, regardless of all of these changes, proposed changes, pending changes, our job as financial crime professionals is to find dirty money and report it in a timely fashion to our law enforcement partners, right? That is the 50,000-foot level of anything that we're doing, collecting the CIP, collecting the I-10, figuring out whether or not somebody's here legally or not. All of that is to provide contextual data to a decision to report something. And I feel like that's lost, and it gets lost in the noise. But to take it a step further, I think saying that is kind of platitude, and I don't like that. I think the feat that you actually have to that statement is looking critically at your own program, regardless of whether or not you're a fintech, you're partially regulated, maybe your bank partner is the one that puts the heat on you, your money service business, you're kind of regulated, you're a bank, you're a securities firm, you are a credit union, whatever you are, looking at your program critically, looking at your last audit critically. But looking at your program and saying, have I actually received a phone call from any agent, local, federal, about any of the SARs that I've submitted? If the answer is no, then you have some work to do. Either you're not finding the dirty money that is there, or your SARs are not convincing enough. That's typically one of the 2 ways that it falls. It's not that these agents aren't hungry for this. They are. I get to work with a lot of them.
Sure.
And so I think that would be the main thing is, the feat to doing that is, are you getting any calls? If you aren't getting any calls, it's been 6 months, it's been 12 months, it's been years. That's a sign that what you're giving, our full reason why we're doing this is not as effective as it should be. And that's a tough thing for some people to swallow.
Yeah, sure. Wouldn't it be nice? We talked about this before. There was a BSA reform hearing a couple weeks ago on the House side. But if we really wanted to reform and improve the 50-year-old laws and regs came over time, why wouldn't we establish a commission, right? Now, the BSA advisory group, fine. I actually wrote the legislation that created it, so I have a warm spot in my heart, although I haven't been involved in that in decades. Wouldn't it make sense to get all the stakeholders together, and I mean all the stakeholders, and do a 9, 10 month commission study of all this, including what you've just talked about? What is the reason we do this? And it is to get information in the hands of law enforcement. That's always been the original and outstanding issue, and we've get away from that. And this isn't to just blame regulators. I blame policymakers. Because I've been part of this for decades. We simply added laws every couple of years because it was an election year and we needed a tough anti-crime bill, and we never went back and said, well, maybe we don't need. We've gone back a little bit, but not enough, and we haven't covered everybody. 25 years ago, when the Patriot Act was working its way through, we were asked as a banking association what we wanted. And we said we wanted two things. Whatever you do, do it by regulation so we can comment and cover everybody. And they started to and never did because, as we both know, some lobbying groups are stronger than others. So again, that's why I worry about the crypto space, the fintech space, because it's fine to have these new platforms. That's not the comment. The comment is they should have some ability to assess suspicious activity. And everybody should agree that should be a common theme. And I think that goes to your overall point.
Well, yeah. And actually, what you just said is directly out of that $108 million asset bank penalty.
Right,
They
yeah.
specifically stated in there that the CIP program must feed the suspicious activity monitoring program, and it must feed the CDD program, which we kind of knew about the CDD, but to see them, close that loop between what you just said about how, priceless the CIP function is, we can't have a proper suspicious activity monitoring program if we don't know who the heck we're doing business with, right? And so I think that that's never going to go away.
Yeah, I agree. Sarah, thank you for your conversation this month. We will see you next month. And again, it's Dirty Money Weekly. And also, they should follow you on LinkedIn. Thanks so much.
Thanks.